So just to give you an overview of this course, we will be covering up the financing of business, how the businesses are financed, whether it's a stock or debt, what are they, how they are valued. Then we will be understanding the underlying concepts of time value of money, interest, valuation principles. After we have looked at the finance, then we will look at the investment decisions. So we will be looking at the required rate of returns, cost of capitals, which are basically a method to or a tool to determine whether the investment is profitable or will be increasing the value to the company or not. So we'll be looking at some capital budgeting methods that we normally make in use in the business in order to make the long term decisions on investment. And then we will also be looking at the day-to-day control of the finance, where we are seeing the working capital management in terms of cash flows, in terms of AR, in terms of accounts payable, and other things. So this course basically is on the financial management, managing the finances of the company. Now, there is a big difference between accounting and finance, which I hope you understand already, but just to reiterate it, accounting mostly is responsible for recording the transactions only, whether how the transaction has done, all the monetary transactions, right? And also conduct the analysis part of it. But when it comes to controlling the money part, whether we need to raise, whether we have excess money, how we invest that, those kind of decisions are taken by corporate finance professionals. So in smaller organizations, there is no different persons doing the accounting and making the finance decisions. But in a very large organizations, there are separate peoples who are handling the money, i.e., the treasury and the corporate finance, and those who are just focusing on recording the transactions. So there are two different verticals of finance, which in small organizations is taken by one person, and in larger organizations is taken by separate persons. So understanding the finance is critical not only from the business or professional point of view, but also from your personal point of view. Everybody of us is making different decisions in our personal finance, in our lives, such as when you should be starting saving, how much money do you need for your retirement, where you should be investing. You should be investing in debt, you should be investing in equity, you should be investing in company or startup or gold or property or wherever, and how much money do you really need. So there is a big decision in personal life that we normally make, whether you should buy the car or whether you should take the car on lease, whether you should take the outright cash down payment or you should take a car loan, which one is cheaper. The same goes for your house, whether you where you should be investing, whether you should put it on rent, whether you should sell it off, whether you should take a loan on your house. So these are the decisions that are bothering everybody, and we struggle to make the decisions because we may be making decisions out of gut feeling. We don't really do the calculations on which alternative is going to maximize our wealth, right? So our goal in personal life is to increase the wealth of ourselves, and our goal in the business life is to increase the wealth of the company, or i.e. wealth of the shareholders. So, which stock is a good investment? How to evaluate the terms of a mortgage? It can be the loan, whether we should go for the fixed rate or whether we should go for variable rate, how much down payment I should pay, and all those kind of decisions normally you make in your personal life, right? In the business life, also we are making decisions whether we should be launching a new product, which supplier we should choose, which equipment we should choose, how much capacity we want to make, whether we should make it ourselves or outsource the production, right? Whether we issue the new stock or borrow money instead of issuing the new stock from the bank, or we take money from the open finance, or we take money from the microfinance. How can we raise the money for your startup firm? So whether it's personal finance, is from the savings, is from the loan, friends, families, crowdfunding, and all those kind of things. So there are quite a lot of decisions we make on in our business from personal point of view and also from the business point of view. So in this course we will be covering up the fundamentals of how we make those decisions, and we will be building up our knowledge from the ground up, means understanding the basic terminologies until how we make the decisions of evaluation. There are basically four type of firms in existence, and there we are talking about mostly on the profit making entities, not the non profit making entities or not the government entities, even though they also need to make the capital corporate finance decisions. The considerations and the motivation of making the finance decisions for governmental organizations and non-government organizations is different. The basic difference between a company or sole proprietorship or a partnership or a limited liability company or a corporation and the NGOs and government is the ultimate objective of these two type of entities. When the business entity is there, their main goal is to increase their wealth. The main goal is to earn more money, earn more return on for their shareholders. While for NGOs and government, the main goal is not about the money, the main goal is on the welfare of the people. So the underlying objective of making decision itself is different. So the corporate finance principles may not apply on those entities. So hence we are not discussing those entities here. So what is a sole proprietorship? The sole proprietorship basically is you yourself, your own. So it's a straightforward thing, and 80% of the businesses, 90% of the businesses run on this model. Whether it's small street corner shop, whether it's a juice corner, it's a kirana shop, whether it's a grocery shop, even a service guy who is just coming and cleaning your aircon, they are all sole proprietor businesses, right? So it's a very straightforward form of business. The only limitation here is that there is no separation between the firm and the owner. The company and the owner is the same person. So there is usually a mix of objectives between the company and the owner of the company. Ideally, it should be different, but in sole proprietorship, they are not different. So, and when the owner is dying or owner leave the business, that's a problem with the sole proprietorship. The continuity is not there. And the firm can have only one owner. The fundraising capacity of the sole proprietorship are also very limited because of the risk involved in continuity of the business. Owner has unlimited liability for the firm's debt because they are one and the same thing. So in unlike the corporates where your liability is limited to the amount that you have already paid for shares, if there is a company, if there is a loss, it doesn't come to the shareholders. In sole proprietorship, it can, you are liable for your, even for your personal assets. So if you have taken any loan for business, you're not able to repay it, you have to pay it out of your personal assets because there is no separation between the firm and the owner. And the life of the company is limited to the life of the owner unless you delegate it or inherit the business from your to your son or your daughter or your friends or anybody else, but in that case the business will change to other person. It's usually difficult to transfer the ownership of, so even if you want to sell the business, it's very difficult for the new person to carry on goods, the goodwill of the sole proprietor. Even if let's say a doctor is selling his business to another doctor, so the goodwill of the previous doctor may be helpful in some, to some maybe 1 year, 2 year, 3 years, but after that the owner of the business will have to create their own skills and it depends on their own skills, right? So that's the sole proprietorship. Then you have partnership, which is similar to sole proprietorship. The only difference is in sole proprietorship there is one owner. In partnership there are more than one owner. So there may be up to, in some countries partnership can go up to 10 peoples only, some countries allow up to 50 peoples. So it depends on the local regulations where the partnership is formed. Certain countries allow the partnership to be built on limited liability, but usually in a general sense partnership is also similar to sole proprietorship, is unlimited liable to the firm's debt. So all the partners are liable to firm's debt in their proportion of capital contribution. If they are equal partners, they are equally liable. If they have certain different ratios of their capital contribution, they will be liable in their own contribution, right? So a lender can require anybody, any partner to repay the firm's outstanding debts. But the thing is, partnership does not end with the death of a single partner. So unless all partners die, then only the partnership will be ceased. Otherwise, the partnership will continue. They may add new partners, they may remove the partners. So that's how the partnership works. And it can avoid the liquidation if the partnership agree provides, such as buyout or decease or a withdrawn partner. So normally the partnership can survive the death or insolvency of one or two partners if the partnership agreement is providing for it. There is a limited partnership. As I said, in some countries it's legal to have limited liability partnership, where you can define the liability of partners to a certain extent only, right? So it's a two kind of owners. There are general partner and there are normally a limited partner. The limited partners will have limited rights, the general partners will have the same rights as the other partnership, but they are personal liability for the firm's debt to their until to the limit of their own assets as well, right? But they also get the higher share of profits in that case. And then there are limited partners, so their ownership is transferable, just like a stock company which is limited by the stocks, and they have no management authority in that case. So these are limited liability partnership. There is no general partners. All the owners have limited liability, but they run the businesses. So these are the different type of scenarios in different countries. It runs on a different basis. Certain countries they don't allow limited liability partnerships. Certain countries allow limited liability partnership. Then there are corporations. Now, the corporations are limited company, like you might be hearing public limited, private limited, or these kind of companies which are incorporated with the company's registrar. And the main difference between these companies or corporations and the sole proprietorship or partnership is that the legal entity is created. Corporation is a legal being separate from its owners. So those who are founding the company, they are own legal peoples, and the company itself has their own legal entity. And this legal entity can sue anybody and can be sued by other peoples. So and it has a legal power to enter into contract, acquire assets, incur obligations, and enjoys the protection against the US Constitution against the seizure of its property, which means it's the company is solely responsible for its own obligations apart from the shareholder. So imagine a case where you have two partners, two brothers setting up a company, and the company is now become a third entity. So essentially the company and the brothers are the same because this is run by the same company, but they do the business in the name of company, and they acquire assets, they acquire the loan, and they run away with it, right? Now the company, as because it's a legal entity, their liability is limited to the money they have. You cannot ask the partners to pay for their personal from their personal assets to the company unless there is a fraud or there are other cases where courts can say, okay, these the shareholders and the company are one and the same thing, and they are personally liable for all the debts of the company. There are defined cases for that. There are defined scenarios for when the company and the owners are treated as same in the law, but in general terms company and the owners are different, and the owner of the company are not liable to obligations of the corporation, whether they are borrowing more than what they have, whether they are losing the money. So it's not their responsibility, and the corporation is not liable to the personal obligations of its owners as well. So it's vice versa. And the formation of company normally is legal, and you have to submit the documents to the Directorate of Company Affairs. For example, in Myanmar, it's DICA, Department of Company Affairs. In India, is Company Registrar. In US, is also the SEC. So there are there are different organizations in nominated by government who are taking care of registration of the companies. Some companies can be listed on stock exchange. So there is another difference that we will tackle later on. And the company need to have their own name. The company need to have a rules how which by which they will be run. So they have their own charter. Like the individuals, they have their own vision, mission, and their rules how they will behave. The company has also its core charter, what it can do, what it cannot do. Normally it's called articles of association. They normally will define up to what amount the company can borrow, what kind of business company can run, what kind of businesses company will not do, what will be the responsibilities of their shareholders, how it will be responsible to its directors, how they will appoint the directors, whether they can have more shareholders or not in the future, and if will there be any limit on the number of shareholders, how often the shareholders are required to meet, what kind of decisions shareholder will make. You say that all the decisions has to be taken unanimously, then you can put that into the articles or the company rules. Then all the shareholders have to follow the company association. Any decision which is going against their charter will be illegal. So whenever the company is usually dealing with the outside entities, they will ask for this charter so that they can read what company is legally entitled to do and what company is legally not entitled to do. So the banks, governments, individual big organizations, they will ask for charter and they will read it just to make sure that the transaction the company is doing with them is legal, right? There are usually, and it's usually more a bit of expensive compared to setting up a sole proprietorship. Sole proprietorship you can set up just by putting a board on the top of your house, say Manish Gupta and company. That's a sole proprietorship done. No other registration is needed. Only the cost is to print the banner. Finish. But if I want to register Manish Gupta Private Limited, I have to go to the registrar. There is a fees to apply. If I don't know how to write the charter, I have to hire a legal company to write the charter for me. They may charge their fees. I may not know where to go for depositing it, so they may help us setting up. So there will be some legal fee initially. Then you have to print the name on the cards. Then you have to print also the advertise in the newspapers. So there is a quite a bit of expense in terms of to setting up a corporate company. But there are benefits as well, right? Because the company is different now from this owner. So there's obviously a benefit. If you have a big organization, a big business, setting up company is better. But if it's a small business and not much of transactions are happening, then you can run it with the sole proprietorship as well. So that's the difference in the public limited and corporations. So in US at the moment you will see 71% are sole proprietorships, 17% are only corporations. There are limited liability companies which are about 6.7% and partnerships are about 3.6%. In terms of the total businesses, right? The number of businesses. But when it comes to the revenue, because the sole proprietorships are very small in the number, that's why their contribution to the revenue is only 3% to the overall revenue generated by the companies. The companies are 84.9%, which is the highest, right? So they may be smaller in number, but in terms of business volume, in terms of the revenue generated, they are the highest. So there are tax implications as well on corporate entities. So the corporations, sole proprietorships, and partnerships normally are not subject to corporate tax. They are subject to the individual tax rates. For example, in any country, the major difference on the corporate tax and the limited liability corporations are the difference between the how they define the tax. For individuals, there is always a tax exemption up, some income is exempt from tax, and then after that the tax amount is gradually increasing. The tax percentage is gradually increasing in relation with the increase in the incomes. For example, in India, for example, in US, in Myanmar, right? But for companies, corporate companies, usually it's a fixed amount. So there is no income which is exempt from the tax for corporates. Even if it's $1, they have to pay the tax. And usually it's about 25 to 35%. So even if you have a profit of, let's say, $100, if you are a corporate company, you have to pay $25 to the government. But if you are individual or a proprietor or a partnership, you don't have to do that because they have their own tax rates, which is gradually. So let's say up to $2,000 is exempt from the tax. So anything up to, because the income is only $100, you don't have to pay the tax. So up for a small amount of profit, individual corporations are better in terms of tax saving, but the higher amount of profits, usually companies are better to form. The benefit of setting up the corporate is not same as the shareholder. So it has a larger life. Even if the shareholder die, somebody will carry on its business, right? The individual organization is not going to change. So because it has a legal entity, their shares must be passed to somebody else, right? So it's easier for the corporation, which is registered as a legal entity, to raise the money from the market or to borrow money from the market, and they have no limitation on it. While for individual, it's a bit difficult if you cannot sell the shares to anybody, right? Because you are individual, and it's difficult to take the loans for shareholder for the individual company because our life as a human is limited. So that's the one difference. The second difference is the tax amount. So if you are an individual, if you are a smaller company earning very small amount of money, from tax point of view, from the money point of view, it's better to keep it as sole proprietorship because then you have to pay a lower amount of tax, right? But for a company, you have to pay a higher amount of tax. Assume up to $10,000, it's exempt from the tax. There is no tax that you need to pay up to a income of $10,000, right, in the corporate. And beyond $10,000, you have to pay 10%. But for a company, any amount, you have to pay 10%, even if the rate is the same, but there is always a minimum exemption from the individual, correct? So that's the benefit. But again, in that case, the other challenge with the corporate, with the individual, is you cannot pay salary to yourself, right? So, and you have your own expenses of your telephone expense, you're going out, your personal expenses. You cannot charge that from the income, right? But in corporates, you can charge all those expenses as being, you can pay the salary to yourself, which will be deducted from your profits. All your expenses, personal expenses, can also be deducted from the profits, so long as you can prove that they are necessary for the business, or by policy the company is supposed to give you those benefits, right? The only thing is you have to pay your own individual tax as well. Plus, whatever profit is distributed from the legally formed corporation to the individual in terms of dividends, you again have to pay the tax in certain countries. Dividend is not charged to tax again because you already have paid when you earn it in the company. But in certain countries, dividend again is charged to tax. So just to summarize the characteristics of different type of firms that we have discussed in terms of number of owners, liability for the debts, owner to manage the taxation amount, and ownership changes and resolves the firm. So proprietorship is only one owner. Liability of the firm is of the owner, right? And owner is the one who is managing the firm. And the ownership change, firm dissolved, yes. The taxation is on personal basis. Same for partnership. The only difference is the number of owners can be more. It's say unlimited here because in US law it's unlimited, but in certain other countries there is a limitation on the number of partners that you can have in a firm. Then there are limited liability partnership. In US there is a differentiation between a general partner and a limited partner. In certain other countries it may not have it. Limited partner can also be a major shareholder, correct? So it depends on the partnership agreement, what they are forming. The limited partner can inject the highest amount of capital, but the only thing is that limited partners are, if it's a general partnership, limited partners are not allowed to do the management. Only general partners are allowed. If it's a limited liability partnership, there are all limited partners, then they can either manage by themselves or they can appoint somebody to manage the business. But in principle, usually limited partners are not managing the business. So that is the limited partnership. The companies, normally the corporations usually will have unlimited amount of owners. and the liability on firm debt will not be there. The shareholders are not managing the company. They appoint directors to manage or choose among themselves or hire third parties. And ownership changes dissolve firm, no, then the corporations are not dissolved even if there is a change in shareholders, right? And the taxation is corporation tax, which is slightly higher. It's not necessary. The directors are not required to be shareholders. It depends on the company's charter and the shareholders' will. So normally, what happens is all the shareholders gather together, and then they think, okay, who will be the director to manage the business? So they can either appoint somebody from themselves. Normally, who has the highest number of shares usually will have the right to decide because they have a highest number of share, right? In these companies are running based on the principle of voting, like general voting, like elections. You are putting up the vote, and whoever wins the vote wins the election. So the same way, directors are appointed by elections, by nominations, and by elections in big organizations. So the director may be a shareholder, may not be a shareholder. But if, let's say, the company's charter, which is the core document defining the company, says that the director has to be a shareholder, then there is no choice. Then only a shareholder will become a director. So in these companies, usually when there are operation manager, there are managing director, there are directors who are managing the things. But all of these may have a financial manager who are going to responsible, or there is a position for finance manager. Maybe the owner is doing by themselves, or they hire a qualified accountant for doing that. However, they do, but there is a need for a finance manager. And the role of the finance manager is to do three things. One is to make sure that make the investment decisions where the money of the company will be invested. The finance manager need to understand the cost and benefit of each investment or project, make a decision whether this decision is going to increase the wealth of the shareholder, and is it a good use for the money of the stakeholders who have invested into the company. So it's a responsibility of the finance manager to ensure every investment is worthwhile of making and make financing decisions. So if, let's say, you have a good project to do, you have a good business idea to carry out, but you don't have the money for doing it, so you need to raise the money from market or from the shareholders. So that the finance manager is also going to make the decision how you are going to raise more money for any new, either from the existing owners or buy or get more owners, buy, borrow from the bonds or borrow from the banks, or however they are going to borrow the money. So they are going to make the decision based on certain principles. So we will be looking at those principles later on. And also manage the short term cash needs, as I discussed in the overview of the course, that there are always day to day needs, right? Not every day you are making a investment decision, but there are needs. You have a cash income from the, let's say, daily sale. Now what are you going to do with this cash? You are just going to keep in the safe, you are going to keep in the bank account, in a saving account, or in a current account, or you will buy the shares from this money, or you will do the FD of this money. So what are you going to do? Are you going to pay to the suppliers? When you should be paid to the suppliers, right? So these are all the short term cash, short term needs, short term day to day decisions which the finance manager has to make. So these are the decisions, and this is also known as managing the working capital because it's a day to day working capital. So these are the three main tasks that the finance manager has to do, and we will be learning them one by one in this coming slides. But the overriding goal of this financial management is one, maximize the owner's wealth. Now, what is the meaning of maximizing the owner's wealth? Owners have invested certain money into the company, right? So they want to maximize their wealth, their return, their share prices. If it's a stock company, their value of the business. There are certain valuation principles that we will look at how they measure the valuation. Their target or their performance is measured through these matrices. How well they are managing the cash, right? So the overriding goal is to maximize the wealth of the owners. So normally their place in the corporations is that the shareholders usually own the corporations, but they rely on executive manager. So there is an executive manager for everything. And then there is a corporate, the management team is headed by the board of directors. Board of director is the group of people which is elected by shareholders, right? And who has the ultimate decision making authority in the company. That board of director is going to also appoint a CEO, right? The CEO is going to be the person who is will be dealing with the day-to-day transactions. The board of directors usually are not doing the day-to-day transactions. They are there to make critical key decisions only. But the CEO is the one who run the show in guidance with the board of directors, right? So after under the board of director and the CEO, usually there is a CFO, chief financial officer. So we will not be talking about the other operational delegations here. And the CFO usually will have a controller who will have accounting department and also a tax department, and a CFO may also have a treasurer, right? So to manage the capital budgeting, to manage the cash, to do the risk management, to do the credit management and everything else. And then there is a chief operating officer at the end, the CEO may have it, right? So this organization chart, it depends on the size of organization. So there may be a manager who may be the CFO and maybe the controller and the treasurer itself, right? So all the three positions are combined into one. So there is no separate person for managing the accounting and the tax and treasury. For example, myself, I'm managing the all the three roles by myself. I don't have a controller separately. I don't have a treasurer. So all these two functions is done directly by me. But in super large organizations, usually a treasurer is a separate person, is a specialized job, and controllers who are responsible for accounting and tax are also a separate person. Now let us look at two things. One bigger problem in organizations that usually happens in organizations is called the agency problem. Now, what is the meaning of agency problem? As we are saying that the managers, the CEO and the COO and the CFO, the board of directors are agent of shareholders, because shareholders are the ultimate owners of the company, right? But they are not managing the business by themselves. They are relying on the board of directors to make the decisions. So board of directors are agents of shareholders, right? CEO, who is also appointed by the board of directors, is also the agent of shareholders, because they are all working in their interest to make sure their wealth is increased. So all the management team is actually a agent of the shareholders. So what is the agency problem then? The agency problem is that when the managers put their own interest ahead of the shareholders' interest, so they may make certain decisions where it will not be in the interest of shareholders, but it may be in the interest of themselves. So, just to give you a few examples, let's say they make a luxury office, they buy luxury cars for their own transportation, right? So, for ferry, they can buy a Lamborghini because the shareholders are not there, but the money is provided by shareholders, and the board of directors are ultimate decision makers to use the money, right? So they may buy a big cars for their own self, they may buy big houses on their own self from the shareholders money. In the name of that company, they are using it for company, but they make use of these resources. The CEOs can use their resources to for their own benefit. They can enroll themselves into very expensive organizations, right? They can go business class travels where even if it's a short trip. So usually there are these kind of problems where they put their own interest on top of the shareholders interest. So there is sometimes agency problems. Whenever there is these kind of problems, things are has to be handled by the shareholders. So the CEOs, for example, the CEO's performance is usually also the linked, and there is usually an incentive, right? The CEO's performance is linked to the company's performance, so which may lead to make him poor decisions, right? The company say that okay, the CEO's incentive or the bonus will be linked to the share price increase. So their decision is going to be, their focus is going to be only on the share price increase. And that's what happens in the past, where there are many frauds which had happened in the US history or Indian history, where the CEOs or the directors are focused only on share price increase. They may also manipulate the results of the company performance, so that in the market the share price keep on increasing and they get their own incentive and their own bonuses, even though it does not increase the shareholders wealth, right? So that's the problems usually. So certain examples, employee can build a gym when which they can use at lunch and hour after 5. So they want the management to build a gym. Now the management can say it's good for motivation, but it's not increasing the shareholders return. So there is always a gray area, right? So you can say, if employee are motivated, they will be doing good job and the shareholders return will be increased. But as a shareholder, you may think the other way around. You may think that it's not required, right? So there are usually these kind of problems. Then there is a conflict between the stockholders and the employees, or CEO build their own residential complex or hire expensive car for themselves, or they make the expensive club membership for their executives. So they may try to justify this as a benefit for the company itself, the for the business, but the shareholders may see it differently, right? So these are the causes of usually a agency problem, when shareholders need to make decisions on what they want to do. So they normally set up the criteria, like there is a document called delegation of authority, right? So with delegation of authority, when they are delegating to the board of directors delegate certain powers back to the executive. So the executive make their decision within those limits. So there are usually processes around the companies, but for small companies maybe there is not so much processes. So one of the job of the finance managers is also to make sure that it does not happen, because ultimately finance managers are responsible to shareholders and their job is to increase their wealth, right? So if the agency problem happen, the shareholders wealth are not increased. But they also have to understand that certain things may be necessary for the employee morale or for the business well-being of the company. Certain expenses may be necessary, so they have to take a balanced approach, make sure that it's not misused, right? So that's the reason.